Good morning. Good morning. I want to believe you can hear me. Good morning. Good morning. Good morning. How are you doing? You're welcome to today's live stream. You're welcome. You're welcome. You're welcome. You're welcome to today's live stream. I believe you can hear me. You're welcome. You're welcome. You're welcome. You're welcome. How are you doing today? How are you doing today? Can you hear me? Can you hear me? You're welcome. You're welcome. It's good to have you in today's live stream. You're welcome. How has been trading? I hope it's been profitable. I want to see your comments. I want to see your comments if you can hear me. I want to see your comments. Good morning, good morning, good morning. I greet you. You're welcome, you're welcome, you're welcome. So today I will be teaching you how to define the market trend using candlesticks. How to define the market trend using candlestick. How to earn consistently from the market. It's very important that you know how to identify the trend of the market. If you don't know how to identify the trend of the market, you would be gambling in the market, and gamblers don't win in this business. You must know how to define the trend of the market. You must know how to identify the trend of the market. And that is what I will be teaching you in today's class. Are you ready? Are you ready? If you are ready, I would like to go in the comment section. Type yes if you are ready for today's class. If you are ready to learn that strategy that is going to make you profit consistently in the market. I would like to see your comments. I would like to see your comments. Type yes in the comment section. Type yes in the comment section. I'll be introducing you to just 4 candlestick pattern. There are several candlestick patterns that can be used to, define the trend of the market, but I will be introducing you to the 4 powerful strategies that you can use, or 4 powerful patterns that you can use to. Are you ready? Let me. Are you ready? Are you ready? Are you ready? Are you ready? Let me know in the comment section. Let me know in the comment section. You're welcome. You're welcome. You're welcome. You're welcome. You're welcome. I believe you can hear me. How is the sound? I believe you can hear me loud and clear. I believe you can hear me loud and clear. You are welcome. 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 I believe you can hear me. Good morning, good morning, good morning. Can you hear me? Can you hear me? Can you hear me? You're welcome to today's class. You're welcome. You are welcome. You're welcome. Comments. You're welcome. You're welcome. You're welcome. You're welcome. You are welcome. You're welcome. Can you hear me? Can you hear me? Can you hear me? Let me know in the comment section. I want to be sure you can hear me clearly. Before we start the class, I want to be sure you can hear me clearly. I want to be sure you can hear me clearly. Can you hear me clearly? Can you hear me clearly? Let me know in the comment section. You're welcome. You're welcome. You're welcome. You're welcome. You're welcome. You're welcome. I want to see your comments. If you can hear me, we're about to start the class. I will be teaching you a powerful strategy, a strategy that you can use to make money consistently from the market. And the strategy is called the candlestick strategy. The strategy is called the candlestick strategy. If you can hear me, I want you to drop a comment. Can you hear me? Can you hear me? Drop a comment. I want to see your comments if you can hear me. How has been trading? Hope it's been profitable. Hope it's been profitable. If you have any question, drop it in the comment section, okay? I would attend to all your questions after treating today's topic, which is candlestick pattern. As a beginner trader, it is very important that you know how to identify these candlestick patterns on the chart. That is the first thing you need to learn as a beginner trader. Okay, is the first thing or the first strategy you need to learn is the candlestick pattern. What you're seeing on the screen is called candlestick charts. What you're seeing on my screen right now is called candlestick charts. There are three types of charts that can be used for market analysis. Can you guys hear me? If you can hear me, I want to see your comments. All right, good. Mr. Raphael, good morning. Mr. Adamu, good morning. Good morning. You can hear me? I want to believe the sound is loud and clear. Okay, so what you're seeing on the chart on the screen right now is called the candlestick charts. There are three types of charts that can be used for technical analysis. Okay, there are three types of charts that can be used for technical analysis, and what you're seeing on the screen right now is called the candlestick chart. We have the line chart, okay, and we have the bar chart. You can use any of these three charts for your analysis, for technical analysis. We have the candlestick and we have the line chart. Now, the most used chart for technical analysis is the candlestick chart. The most used chart is the candlestick chart, and I think it's because the candlestick chart can easily be read and interpreted. That is why most people prefer using the candlestick charts. And in today's class, I will be teaching you how to use this candlestick in identifying the trend of the market. There are three types of trend. Price would move in three directions. The market will move in three directions. Okay, you need to know the type of the trend that the market is in for you to be able to take advantage, or for you to be able to make profits in the market. You need to know the direction of the market, and there are three types of direction. We have the uptrend, we have the bearish trend, and we have the sideways trend. The uptrend is also referred to as the bullish trend.
The downtrend is referred to as a bearish trend, and the sideways trend is also referred to as a consolidation phase. So as a trader, before you execute the trade, you need to know the direction of the market. For example, what we have here on the charts, you can see what we have here. From this point to this point, you can see it is obvious that the trend was bullish. You can see that from this point, the price was bullish. Price went up. When we use the word bullish, we mean to say price is going up, or price has been bullish. Price has been going up for some time. So if you look at what we have here, this is an example of a bullish trend. From this point to this point, price went up. So as a trader, before you execute the trade, you want to know if the trend is bullish. And when the trend is bullish, you want to look for a buy opportunity. And also, it is very important. It's not just about knowing that the trend is bullish. You also need to know the right time to execute the trade. That is why you have candlestick pattern. It is not just about knowing the trend. You need to know the right time to execute the trade. And that is what I will be teaching you today. Knowing the right time. What candlestick pattern should you see before you buy? What candlestick pattern should you see before you sell? Trading is not complicated. Making money from the market is not complicated. You are the one who is making it so complex, making it look as if it is so difficult. It is not complex. It is not complicated. Okay, so this is an example of an uptrend. Now, we're looking at GBP USD. GBP USD. I want to assume everyone in this class has the basic knowledge of Forex trading. Okay, now this pair we are looking at right now is GBP USD. If you look at GBP USD for some time now, for some months now, GBP USD has been bearish. GBP USD has been bearish. You can see from this point to this point, you can see the price of GBP USD has been dropping. It has been dropping from this point. It is obvious that GBP USD, you can see it has been dropping. So GBP USD has been bearish. It has been bearish for some time, for some weeks, some months now. GBP USD has been bearish. And since the trend has been bearish, you should be looking for opportunity to sell. Now, let me define what a candlestick pattern, what a candlestick is, before I start teaching you how to identify these patterns on the chart. What is a candlestick? A candlestick is a graphical representation of price action. A candlestick is a graphical representation of price action. What this candlestick shows you is the opening, high, low, close price of an asset or of an instrument, or yes, of an asset within a given period of time. That is what this candlestick shows you. It shows you the open, high, low, close price of an asset or an instrument within a given period of time. So with that idea, if you have the knowledge of what price has done in the past, you would be able to predict what it is likely going to do in the future. So as you can see, the trend has been bearish. And since the trend has been bearish, you cannot buy. You cannot buy. You would only look for sell opportunities. Are you following? Are you with me? You would only look for sell opportunities because the trend has been bearish. Now, I want you to understand that a trend that has been bearish will not be bearish forever. Are you getting me? A trend that has been bearish will not be bearish forever. At some point, the trend will change. At some point, the trend will change from being bearish to bullish. So as a trader, you need to know when a trend is about to change from bearish to bullish and from bullish to bearish. It is very important. A lot of people will be looking at the charts now. It is obvious that GBP USD is bearish. The trend is bearish. But the next question you need to ask before executing a trade to sell is, if I buy or if I sell at the current market price, would that be a good investment? Looking at where price is now, if I sell at the current market price, would that be a good investment? Like I said, this is where GBP/USD price started dropping. This is where GBP/USD price started dropping, and right now it is currently trading at this price. Now, if you didn't sell from this point, 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 why would you want to sell at this point? Why would you want to sell at this point? This pair has done over how many pips from this point? Let's just calculate from this point. It has done over 548 pips. 548 pips. You can see that. So if you didn't sell from this point, why would you want to sell from this point? So you need to know when a trend is about to change from bearish to bullish. Looking at the charts now, there is a high probability that price will pull back. There is a high probability that the trend is likely going to change from bearish to bullish. So what should you look out for? How would you know that the trend is about to change from bearish to bullish or from bullish to bearish? Candlestick pattern. And the first candlestick pattern I want us to look at is the Doji candlestick pattern. I want to believe you're taking notes. The first candlestick pattern that I want us to look at is the Doji candlestick pattern. What does a Doji candlestick pattern looks like? I will show you on the charts. What does a Doji candlestick pattern looks like? I believe you can see my screen. This is what a Doji candlestick pattern looks like. Can you see this? This is what a Doji candlestick pattern looks like. This is another example of a Doji candle. Can you see this? This is a Doji. This is a Doji. Can you see that? This is a Doji. This is what? A Doji. A Doji candle is also referred to as indecision candle. A Doji candle is also referred to as what? Indecision candle. And how do you identify a Doji candle from other candlesticks pattern? A Doji does not have a body. As you can see, this candle does not have a body. So a Doji does not have a body. You can see also this Doji does not have a body. And that's because the opening price of the Doji is the same as the closing price. Remember I said a Doji candle shows you four prices. It shows you the opening price, the high price, the low price, and the closing price. That is what a Doji candlestick shows you or displays. You can see when I applied my cursor, when I placed my cursor on the candle, you can see the four prices that is being displayed: open, high, low, close. Okay, this is what is displayed when you position your cursor on the candle. It displays the open, high, low, close. But on a Doji, you would notice, you would see that the closing price, look at this, this is a bullish candle. If look at the opening price and the closing price, you would see that there's a difference between the closing and the opening price. Can you see that? There's a difference. You can see the opening price is 1.2909 and the closing price is 1.2985. So there's a difference in the opening and the closing price. But when you look at Doji, the opening price is the same as the closing price. Can you see that? The Doji, the opening price is the same as the closing price. That is why it is referred to as what? Indecision candle. A Doji indicates weakness. Doji indicates what? Weakness. It indicates that the bulls are either getting exhausted or the bears are getting exhausted. That is what a Doji indicates. I hope you are following. A Doji indicates that the bulls are getting exhausted or the bears are getting exhausted. Now, this Doji candlestick can form in an upward trend and it can form in a downward trend. A Doji candle can form in an upward trend and it can also form in a downward trend. Are you guys here? Are you guys here? Can you still hear me? Can you still hear me? I want to see your comments if you can hear me. Drop a comment if you can hear me. And I hope you're taking notes. drop a comment if you can hear me, and I hope you're taking notes. It's very important that you take notes, okay? So, like I said, a doji indicates what? Weakness. Weakness. And the doji candle can form in an upward trend and in a downward trend. So, a doji is a bullish reversal pattern and also a bearish reversal pattern. A doji is a bullish reversal pattern and it's also a bearish reversal pattern. Now, when a doji forms in an upward trend, just as we have it here, can you see that the preceding trend before the formation of this doji is bullish? You can see that before the formation of this doji, you can see that the trend is what? Is bullish. So when a doji forms in an upward trend, it indicates that the trend is about to change. It indicates that the buyers are becoming weaker. They are getting exhausted. It indicates that demand is beginning to decrease and supply is beginning to increase. That is what a doji candle forming in an upward trend indicates. Are you with me? So when a doji forms in an upward trend, you should be looking out for sell opportunities. You should be looking out for opportunity to sell. If you are bought from this point, immediately a doji candlestick forms in an upward trend, you should be planning to exit the trade. So you can use your doji candlestick pattern for entry and also for exit of your trades. You can use it in executing a trade, in opening a trade. You can also use it to what? To close a trade. So as you can see here, the preceding trend was bullish before the formation of a doji. Remember I said a doji is an indecision candle. What that means is that we can't just execute the trade since it's an indecision between buyers and sellers. The doji does not tell us that we have more buyers in the market. In this case, the doji does not tell us that we have more sellers in the market. What the doji is telling us here is that the buyers are becoming weaker. That's what the doji is telling us, that the buyers are becoming weaker. Now, when a doji forms, you want to sell. But before you sell, please note this. When a doji forms in an upward trend, you are looking for opportunity to sell. But before you sell, you must ensure that a bearish candle closes after the doji. Please note that when a doji forms in an upward trend, you must ensure that the next candlestick closes bearish before you sell. Let me show you that on the chart. Let me use the chart to explain what I just told you guys. Now, this is a doji. Now, look at this doji. Now, this doji formed, telling us that it's time to sell. If you had executed a sell from this point, there's a high probability that the market would have taken you out. Your stop loss would have been cleared. The rule is after the formation of a doji, wait for a bearish candlestick to form. Now, on this chart, I should have mentioned this before, looking at what a doji candle is. On this chart, we have two candlesticks. We have bullish candles and we have bearish candles. The bullish candles are the blue candles are my bullish candles, and the red candles are my bearish candles. Any color can be used for these candles. Okay, when your default color is black and white, I customized my candles to red and blue. I prefer color than the white and black. Okay, so the bullish candle. Now, how do you identify a bullish candle from a bearish candle? I can decide to use red candles for all my candles. I can decide to use blue color for all my candles. So if all the candles are in blue color, how would you be able to identify a bullish candle from a bearish candle? If everything is blue in color, how would you be able to identify a bullish candle from a bearish candle? Now, let me define what a bullish candle is. When a candle closes above the price it's opened, remember I said earlier that the word bullish means price is going up. Price is going up. So it means that for a candle to be bullish, that candle must close above the price it's opened. It must close above the opening price. Are you with me? So this candle is a bullish candle because the closing price is higher than the opening price. If I place my cursor on the candle, look at the opening price and also look at the closing price. You can see that it's the same thing. Sorry, you can see that the opening is lower than the closing, right? You can see it. The opening price here is 1.2783 and the closing price is 1.2848. I believe you can see that. The opening price is 1.2783. The closing price is 1.2848. You can see that the closing price is higher than the opening price. That is why the blue candles are my bullish candles and the red candles are my bearish candles. Bearish means the market or the candle closed below the opening price. So when we say a candle is bearish, we mean to say that the closing price is below the opening price. It means the candle closed below the price it opened. Let me place my cursor. Look at the prices. Just compare the opening and the closing price. Can you see the opening price? Compare it to the closing price. You will see that the closing price is below the opening price. It's lower compared to the opening price. That is why the candle is called a bearish candle. I hope that is clear. So like I said, when a doji candle forms in an upward trend, you wait for the next candle to close bearish. If you had executed sell after the formation of this doji, what would have happened? Your stop loss would have been cleared. So you would have waited. Now on this at this point, you can see the next candle that formed there. It is not a bearish candle. You can see the body is bullish. It means no trade. It means the sellers are not ready yet. It means there is still little demand in the market. It means there are still buyers in the market. There are still few buyers in the market. There are still few traders in the market who are willing to buy. So you cannot sell. The next candle that closed after this is also a bullish candle. That tells you that there are still traders who are still willing to buy. Are you with me? And the next candle that closed after this candle is a bearish candle. It is after the close of this bearish candle you would execute a sell trade. This is the close of the candle. This is where you would execute the trade. These things are not complicated. Keep it simple. I always tell every newbie trader, if you are new to keep it simple, stupid. You don't have to know ICT. You don't have to know Elliott Wave. You don't have to know you don't have to know SMC. A lot of complicated systems out there. I know all this strategy, but when I'm teaching, I teach simple, basic concepts that can make you profit consistently. It doesn't be complicated. The reason most of you are struggling in the market is because you're trading complicated systems. The system you're trading with is too complex. That is why you're not making money consistently in the market. And I understand why most of you are interested in complicated systems. I understand why. I understand why. It's the way our mind has been programmed. It's the way your mind has been programmed. Your mind has been programmed that it has to be hard. You have to do hard work to make money. That is why you are interested in all this complicated system. It's the way your mind has been programmed. So this is where you would have entered the trade. Keep it simple if you want to make money in Forex. The people that make money in Forex keep their strategy simple. Don't complicate things for yourself. Keep it simple, okay? So it is at this point, after the formation of this bearish candlestick, you would execute a sell trade. And you can see what happened. You can say what happened to price. After the formation of this candle, price dropped. You would have made good profits. But if you had entered immediately the candlestick, a lot of traders are impatient. Many would have jumped in here. This is a doji candle, it's time to sell. They would have jumped in without waiting for the next candle to close bearish. People that will complain that the market went against me. Why won't the market go against you? When you are not patient, when you are not following the trading plan. when you are not sticking to your trading rules? Why won't the market go against you? You will always be the liquidity. Your stop loss will always be the liquidity in the market. So you have to be patient and follow your trading rules. So if you're trading the Doji candlestick pattern, once the Doji forms in an upward or downward trend, wait for the next candle to close. If it's an upward trend, wait for the next candle to close bearish. If it's a downward trend, wait for the next candle to close what? Bearish before you sell. This is an example of a Doji candlestick pattern playing out. You can see this is an example. Let me look for one or two more examples before we look at the next candlestick pattern. Let me look for another example of a Doji pattern. Yeah, so can you see this? I believe you can see this. I believe you all can see this. This is a Doji. I believe you all can see this. This is a Doji. The preceding trend is bearish, or the candlestick that closed before the formation of this Doji is what? Bearish. You can see the candlestick that formed before the formation of this Doji is bearish, and the trend before the formation of this Doji is what? Bearish. So after the formation of this Doji, you look out for buy opportunity. Remember, Doji just tells you the market is about to change its direction from bearish to bullish. That is what a Doji candle, tells you, that the market is about to change from what? From bearish to bullish. Are you with me? Are you with me? Are you with me? Are you still here? Are you still here? Are you still here? Are you still here? So that is what a Doji candle. So a Doji tells you here now that the market is about to change. You are not to jump in and start buying. You are not expected to jump in and start. What is the rule? Wait for the next candle. Since the preceding trend was bearish, we need to be sure that we have buyers in the market. We need to be sure that there are traders who are willing to execute buy trade. Because the more people execute buy trade, the more there is demand. That's when the price would go up, will shoot up. So this Doji just tells you it is time to what? To buy. It is time to buy. So you need to wait for this next candle to close bullish before you buy. Is this strategy not simple? Is it not simple? Wait for the next candle to close buy before you execute the trade. You can see this. Let me look for another example, one more example. So we've seen an example for buy, we've seen an example for sell. Let's look for another example. Let's look for another example. Let's look for another example. You can see this. Can you see the pattern we have here? This is a Doji. This is a Doji. Can you see this? Can you see this? Can you see this? Can you see this? This is a Doji. And the Doji indicates what? Change in trend from bullish to bearish. Change in trend from, in this case, you have from bullish to bearish. So you can see after the formation of this Doji, that is not the time to execute a trade. That is not the time to execute a trade. Are you with me? You have to wait for the next candle. Patience, patience. You have to wait for the next candle to close bearish. This is where you would execute your sell trade. This candle confirms that there are traders who are willing to sell from this. This candle indicates that supply has started increasing and demand has started dropping. This is the confirmation. You need to wait for the confirmation. Be patient. Wait for the confirmation. Okay, so that is how you trade or you identify a change in trend using candlestick pattern, using the Doji candlestick pattern. Is that clear? Is that clear? Can we move to the next candlestick pattern? Can we move to the next candlestick pattern? Let me know in the comment section. Can we move to the next candlestick pattern? Let me know in the comment section. Let me know. Can we move to the next candlestick pattern? Okay, so the next candlestick pattern we'll be looking at is the spinning top. The spinning top. The spinning top. The spinning top looks like the doji. The spinning top looks like the doji. The difference between the spinning top and the doji is that the spinning top has a small body. That is the difference. A spinning top has what? A small body. A doji, remember, does not have a body, but a spinning top has a small body. This is what a spinning top looks like. I believe you all can see this. This is what a spinning top looks like. A spinning top has a small body, a little wick above it, and a little wick below it. A spinning top has a little wick above it and a little wick below it. This is what a spinning top looks like. Now, this spinning top can form in an upward trend and it can also form in a downward trend. I hope you're taking notes. The spinning candle can form in an upward trend and it can also form in a downward trend. Now, when a spinning candle forms in a downward trend, it indicates change in trend from bearish to bullish. When a spinning candle forms in a downward trend, it indicates change in trend from bearish to bullish. And when a spinning candle forms in an upward trend, it indicates change in trend from bullish to bearish. I hope you're following. When a spinning candle forms in a downward trend, it indicates change in trend from bearish to bullish. And when it forms in an upward trend, it indicates change in trend from bullish to bearish. So let's identify spinning candle forming in a downward trend and also in an upward trend. Okay? Ensure you stay to the end of this class because there's a lot I would be sharing. I still need to tell you the best time frame to identify this candlestick pattern. Okay, I will share with you the best time frame to identify this candlestick pattern. Remember, analysis can be done using different time frames. So you need to identify this candlestick on the right time frame to get a good result. You need to identify them on the right time frame to get the best results. Okay, so let's look for spinning candle pattern formation on the charts in an upward trend and also in a downward trend. Are you guys still here? Are you still here? Are you still here? Can you hear me? Can you hear me? Can you hear me? Okay, so let's identify spinning bottom and spinning top. Okay. Okay. So this is an example, as you can see here. This is an example of a spinning top. Can you see this? This is an example of a spinning top. Okay, let's look for more example. This is an example of a spinning top. When it forms in an upward trend, it is called a spinning top. When it forms in a downward trend, it is called spinning bottom. If it forms in an upward trend, it is called spinning top. If it forms in a downward trend, it is called spinning bottom. Okay, so this is a spinning top. Now, because the spinning top or spinning bottom has a body, the spinning candle has a body, the body could be bullish and it could be bearish. Note that. because the spinning candle has a body, it could be bullish and it could be bearish. So what we have here is a bullish spinning top. It is a bullish spinning top. And when a bullish spinning top forms in an upward trend, just as we have it here, you have to wait for the next candle to close bearish before you sell. Note that this is a bullish spinning top because the body is bullish. And since it formed in an upward trend, you have to wait. Before you place a sell trade, you must ensure that there are sellers in the market. If there are no sellers in the market, it wouldn't make sense for you to sell. It wouldn't make sense for you to sell. Okay? It wouldn't make sense for you to sell. You need to ensure that there are sellers in the market before you sell. So in this case, you would have waited for this next candle to close bearish before you sell. You would have waited for this candle to close bearish before you sell. I hope that is clear. I hope that is clear. Okay? Let me show you another example. So this is where you would have sold. Your entry price would have been this. This is where you would have entered sell. This would have been your entry price for this trade. And you would have made some good profits on this trade. You can see the market dropped. You would have made at least 1 to 2 risk reward on this trade, or more than that, 1 to 3 risk reward on this trade. Okay, let me show you another example of a spinning candle forming on the charts. Can you see this? This is what a spinning top. This is what a spinning top. This is what a spinning top. This is a bullish spinning top, and this is a bearish spinning top. Are you with me? This is a bullish spinning top, and this is a bearish spinning top. Now, after the formation of this bearish spinning top, you don't have to wait for the next candle to close bearish. You don't have to wait for the next candle to close bearish. That the body of the candle is bearish indicates that there are sellers in the market. Are you with me? It indicates that there are sellers in the market. So you don't have to wait for the next candle to close bearish when a bearish spinning top forms in an upward trend. Note that when a bearish spinning top forms in an upward trend, you don't wait for the next candle. So for example here, this candle is a bullish spinning top. So you wouldn't have executed a sell trade because the body is bullish. You would have waited for this bearish spinning top to form before you sell. You would have waited for this bearish spinning top to form before you sell. You're welcome, Mr. CN. You're welcome. Don't worry, I'm going to analyze the market after teaching candlestick pattern. We're going to look at just 4 candlestick pattern. Okay, today we're just going to look at 4 candlestick pattern. Tomorrow we'll look at 3 more candlestick pattern or 4 more candlestick pattern. Then after I'm done with candlestick pattern, we'll be looking at resistance and support. In our next class, I'll be teaching you how to identify resistance and support. And with just these 2 strategies, you can make profit consistently in the market. Forget SMC, forget ICT, forget Elliott wave. Just with resistance and support and candlestick strategy, you can make profit consistently in the market. Okay, so this is an example of a spinning top forming an upward trend, and it actually played out. If you had executed this trade, you would have made a risk reward trade would be like close to 1 to 3. Okay, close to 1 to 3. 1 to 3 if you had executed this trade here. So this is an example of what a spinning top forming an upward trend, and you can see how it played out. Price actually dropped from that point. Okay, so let's look for 1 or 2 more examples. Let's look for 1 or 2 more examples. This is also a spinning bottom. You can see it has a small body, wick above it and a wick below it. This is also a spinning bottom. Now, this is a bullish spinning bottom. And since it's a bullish spinning bottom, you wouldn't wait for the next candle to close bullish before you buy. Immediately this candlestick formed, you would buy. You can see, you would buy. You can see, you would buy, and you would have benefit on this trade. You can see that. Also, here we had a spinning top. You can see it. This is a bearish spinning top. Can you see this? This is a bearish spinning top. After the formation of the bearish spinning top, what happened to price? Price dropped. This is a bearish spinning top. This is another example of a spinning top. You can see the preceding trend before the formation of this spinning top is what? It was what? Bullish. It was bullish. You can see it was bullish, and a spinning top formed. Bearish. You would have executed a sell trade at this point, and you would have made this. The risk reward here is close to 1 to 5. The risk reward here is close to 1 to 5. Now, it's one thing to know how to execute a trade, and it's another thing to know how to manage the trade. Okay, so in subsequent class, I'll be teaching you risk money management. All I've been teaching since we started this class is how to identify entries. It's one thing to know how to enter a trade. It's one thing to know when to exit the trade. Many know how to enter the trade. They don't know how to exit the trade. So you need to know how to execute the trade and also know how to exit the trade. That is risk and money management. I'm going to teach that in subsequent class. Okay. So this is a spinning top, and you can see how it's played out. Sold. This is also a spinning top. Spinning top, bullish spinning top. What do? Wait for the next candle to close bearish. So your entry would have been at this point. This is where you would have entered sell. Always wait. Always wait for the next candle to close bearish before you sell. Always wait. You're welcome, Ebuka. Always wait for the next candle to form bearish before you sell. Okay, so that will be it for Doji candlestick, for spinning top, spinning bottom. Okay, spend time on the chart. After the class, I expect you to go to the chart and look up for these patterns. Go back and see how the market has reacted after the formation of these patterns. How the market reacts after the formation of this pattern. Go back. You need to do back. You need to study. Do back testing. What we've been doing since is called back testing. We are going back to see how the market reacted after the formation of these patterns. Okay, that is called back testing. That's what we are doing. That's what you should do as a trader. In technical analysis, we believe what has happened in the past. We believe history repeats itself. What has happened in the past has a high probability of repeating itself in the future. That's what technical analysis is all about. You need to know the past. You need to know the history. Okay, you need to know the past. You need to know price history. What has price done in the past? That is what will determine what it will do in the future. Okay, so that is it for spinning top and Doji. Any question on spinning top and Doji? Let me know. Any question? Any question? Any question on spinning top and Doji? Any question on that? Let me know in the comment section. You have any question on spinning top and Doji? Let me know. Let me know. Let me know. Spinning top and Doji. If you have any question before we move to the next candlestick pattern. The next candlestick pattern we'll be looking at is AMA. AMA. That's the next candlestick pattern we will be looking at. AMA. AMA. This is what an AMA candlestick looks like. AMA. Can you see this? This is an AMA. Can you see this candle? I believe you all know what an AMA looks like. You know what an AMA looks like. So this is what an AMA candle looks like. Can you see that? Can you see that? So an AMA candle indicates change in trend from bearish to bullish. An hammer candle indicates change in trend from bearish to bullish. So an hammer candle forms in a downward trend. Hammer candle forms in a downward trend. Hammer candle forms in a downward trend, and it indicates that the trend is about to change from bearish to bullish. It indicates that demand is increasing and supply is decreasing. That is what an hammer candle indicates. It indicates that demand is increasing and supply is increasing. Demand is increasing and supply is decreasing. It also tells you that the buyers are becoming weaker and sellers are beginning to show up. The sellers are becoming weaker and buyers are beginning to show up in the market. The bears are becoming weaker. Bears also means sellers. Bears means sellers. Bulls means buyers. So when an hammer forms in a downward trade, it indicates that the bears are becoming weaker and the bulls are becoming stronger. That's what it means. Okay, so this is what an hammer looks like. So let's go back and see where hammer candle forms on the chart, and let's see how the market reacted. Okay, so you can see this. This is an hammer. Now, how do you identify an hammer candle? How do you identify, or how do you know that an hammer is a valid hammer? Okay, the wick below it must be at least two times the body. That is one way to know the candle is a valid hammer. The wick below it must be at least 2 times the body, just as we have it here. This is an hammer candle. Now, an hammer is not supposed to have a wick above it. A valid hammer is not supposed to have a wick above it. But these days, it is very difficult to find a candle without a wick above it or below it. So sometimes you would find a wick on an hammer, but the wick above it must not be too long. Just as we have it here, the wick has to be very small for it to be called an hammer. I hope you're getting me. So this is an hammer, and like I said, hammer forms in a downward trend. You can see that the preceding trend before the formation of this hammer is bearish. You can see it is bearish. So after the formation of this hammer, you buy. Now the hammer has a body. It could be bullish and it could be bearish. Note that hammer has a body. It could be bullish and it could be bearish. If the body of the hammer is bullish, you execute a buy trade after the close of the hammer. Let me repeat that. If the body of the candle is bullish, if the body of the hammer is bullish, you execute a buy trade immediately the candlestick closes. You buy. But if the body of the hammer is bearish, you have to wait for the next candle to close bullish. You have to wait for the next candle to close bullish before you buy. I hope that is clear. So here the hammer is a bullish hammer. The body is bullish. So we don't have to wait for this candle to close before buying. So it is after the close of this candle you would execute your buy trade. Is that clear? Let's look for more examples on the chart. Let's look for more examples on the chart. This is an example of an hammer. This is an example of an hammer. Okay, this is an example of what hammer, because the wick below, I think, is 2 times the body. Okay, the wick below is 2 times the body. Now this hammer is a bearish hammer. This is what? A bearish hammer. Now after the formation of this hammer, you have to wait for this next candle. This is bearish. You wait for this next candle to close bullish before you buy. Is that clear? You wait for the next candle to close bullish. It is after the close of this candle you would execute your buy trade. After the close of this candle, that is when you would execute your buy trade. Is that clear? Is that clear? Let's look for another example. Can you see this? This is an hammer. This is an hammer. Remember I told you these days it's very to find a candle without a wick above it. Okay, so this is an hammer. This is an hammer, a bullish hammer. After the formation of this hammer, you don't wait for the next candle to close because the body is bullish. This tells you that there are buyers in the market, so you can start what? Buying. You can start buying. You don't have to wait for the next candle to close bullish. You execute a trade after the close of this hammer. I hope that is clear. Let's look for one or two more examples before we look at the next candlestick pattern. Hammer. This is another example of an hammer. This can also be called an hammer. This is an hammer. This is an hammer. This is a bearish hammer. This is a bearish hammer. If you had a buy trade after the formation of this bearish hammer, there's a high probability they would have taken you out. Your stop loss would have been hit. If you had set your buy, or if you had executed a buy after the formation of this bearish candle, there's a high probability that your stop loss would have been cleared. Right? It's more important that you wait for the next candle to close bullish before you buy. You can see that. So if you had entered buy after the formation of this hammer, your stop loss would have been cleared. Now this next candlestick hammer, still a bearish hammer, you wouldn't have executed a buy trade. It is after the formation of this bullish candle. This bullish candle, this is the candle that confirms that, okay, now the buyers are taking over. This is the candle that indicates that there are more buyers, or there are more traders who are willing to buy, and that will be the right time to buy. So you can see how the market reacted to this pattern. You can see price went up after the formation of that pattern. Can you see that? One more example. Yes, this is another good example. Hammer. This is an hammer. What happened? After the formation of the hammer, the next candle, bearish. The next candle, bearish. This is a bearish timing top. If this next candle had closed bullish, you would have executed buy. But because the next candle closes bearish, you cannot buy. The next candle here, bearish. The next candle here, Doji, you cannot buy. This already told you that it's time to buy. So you are looking for buy opportunity. So you wait for the next candle to close bullish before you buy. So this would have been your entry for buy on this trade. This would have been your entry buy on this trade, and you would have made profit on this trade. Can you see that? You would have made profit on this trade. Now, this is one thing I want you to understand. This is one thing I want you to understand. Now, you entered the buy here, and what happened? Price came down. Price didn't just go up. It didn't just go in your direction immediately you executed the trade. It just went up a little bit and there was a retracement. It doesn't matter. When you have been able to identify a trend, if a trend is bullish, if your bias is bullish, before the market will hit your TP, most times there will be pullbacks. There will be retracements. Are you getting me? There would be what? Retracements. So you are not to exit the trade, because a lot of people, they panic and exit the trade prematurely. You are not to panic. After you've executed the trade, let the trade play out. Let it play out. Don't say because the trade is pulling back or is going against your prediction, you will not exit the trade. That is why you have stop loss. That is why you have stop loss. Your stop loss should be that thing that will take you out of the market. Are you getting me? Your stop loss is that thing that will take you off the market. take you out of the market. So once you execute the trade, let the trade run. Most people, after executing this buy here, price went in their direction a little bit. Immediately they see that it's moving against them, 1 or 2 pips or 3 pips, they panic and they exit the trade. But you can see here that the market actually went in that direction later. Remember that when you execute your own buy here, there are a lot of people that didn't buy at this price. Many people didn't buy at this price. Many people didn't buy at this price. Many didn't buy at this price. So those who didn't join the trend at its early stage would want to look for a good opportunity. They want to look out for good price. They want to look out for fair price to buy also. They wouldn't want to buy at this point because they see it that at this point it is expensive. This is not a fair price to buy. So they want to see price retrace a little before they will buy. That is the reason for this retracement. Also, those who joined the trend, who caught the trade at its early phase, at its early stage, most of them would want to sell after making profits. They would want to sell after making profits. That is the reason for the retracement also. Some people are waiting for the market to retrace so that they can buy, while those who have made profits also would want to sell. And as they are selling, the price will drop because demand will decrease and supply would increase. So price will drop. So in an upward trend, there will always be a retracement. In a downward trend, there will always be retracement. Note that. So you shouldn't panic when the market is going against you until the market hits your stop. Panic. Wait for the pattern to play out. Wait for the market to do its thing. Can you guys still hear me? Whoa, network. Patience, please, patience. Patience, please. Patience, please. I just hope you guys can still hear me. I hope you guys can still hear me. I hope you guys can still hear me. Can you guys hear me? Drop comments if you can hear me. Drop comments if you can hear me. Drop comments if you can hear me. Okay, I think the network is back. Okay, so patiently wait for the trades to play out. Okay, let's look for one more example. So this is another example of an hammer. I believe you can hear me. This is another example of an hammer. Okay, this is another example of what? Hammer. This is an hammer. Bullish hammer. Bullish hammer. So you execute the trade after the formation of this bullish hammer and you would have made good profit here. Can you see that? This is an hammer. Execute the buy trade after the formation of this candle, this hammer candle. So that is it for hammer. That is it for hammer. Okay, that is it for what? Hammer. Now, this hammer candle can also form in an upward trend. The hammer candle can also form in an upward trend. The hammer candle can also form in an upward trend. Okay, it can also form in an upward trend. Now, when this hammer forms in an upward trend, when this pattern forms in an upward trend, it is not called an hammer. It is not called what? Hammer. It is called hanging man. Is that clear? When this pattern we call hammer, when it forms in an upward trend, when this pattern forms in an upward trend, it is called hanging man. When it forms in a downward trend, we call it hammer. But when it forms in an upward trend, when the preceding trend is bullish and this pattern forms, it is called what? Man. So can you, sorry, I can't see your comment. Oh, can you hear me? I want to believe you guys can hear me. I want to believe you guys can hear me. I want to believe you can hear me. I want to believe you can hear me. Okay. So when this forms an upward trend, it is called hanging man. So let's look for hanging man on the chart. Can you see this? Can you see this? This is what? Hammer. I'm sorry, the network is not stable. Please be patient. Please be patient. Please be patient. The network is not stable. The network is not stable. Patience, please. Let me refresh the network. A few minutes.